Hello students, welcome to Accounting 1304. This is Introduction to Accounting 2. This is Dr. Mercado speaking, and I hope all of you are having a great week so far. This particular week we are going to be covering Chapter 15, which deals with financial statements and year-end accounting for a merchandising business. Okay, this is a very important chapter. We're going to learn how to prepare financial statements. We're going to learn to calculate a variety of financial ratios. We're going to do closing entries. There's a lot of information being presented in this chapter. Okay, it is super important that we read the chapter before we attempt any of your assignments. Okay, that way you have a general understanding, and not only reading but taking the time to review the figures being provided within the chapter text that highlight and explain in detail how to be able to complete these financial statements. Okay, all of those figures are provided to serve as guidance as well as examples to completing your homework assignments. Now, I have selected one problem this week to go over. This is problem 15-8, and the reason I selected this problem is because it allows me to explain about how to create both an income statement, a statement of owner's equity, and a balance sheet for a merchandising business. Okay, so this is going to be a long problem. Now, let me look at my notes here real quick. There must be another reason I selected this problem. Let me see. Yep, sure enough. You're going to be seeing something similar to this on your test. Okay, so that is the other reason that I selected this problem, so I could cover it with you, because you will be seeing it in your upcoming test. So it's important that you clearly understand how to do problem 15-8. Okay, so let me jump over to the actual problem. Okay, like all of the weeks, I'm not going to go so much over the content, but actual application of the content to the problem. Okay, so this problem says, this is problem 15-8, income statement, statement of owner's equity, and balance sheet. Paul's pet store completed the adjusted trial balance below for the year ended December 31st. Owner's equity as of January 1st was $504,320. The current portion of notes payable is $2,000. We are required to prepare a multiple step income statement, a statement of owner's equity, and a balance sheet. Okay, and then we are provided with the end of period spreadsheet. Okay, that we're going to be using to be able to complete our three financial statements. Okay. So the first financial statement that needs to be completed is the multiple step income statement. Okay, so we've got the name of the company, Paulson's Pet Store. This is the income statement for the year ended December the 31st. Okay, on our income statement, we always begin with our revenues. Okay, always begin with our revenues. Okay, so before we even start typing, let's go and identify our revenue accounts. Okay, so our revenues are located down here. Okay, so we've got sales of $326,040, but right below it we have sales returns and allowances, okay, of $5,360. Okay, so these are the two accounts that we're going to be using to calculate our net sales. Okay, so let's start off with our sales. Okay, revenue from sales, and first we're going to start with our sales. And my sales figure was $326,040. Okay. Okay. Then I also have, and as you're working the problem, make sure that you mark off the numbers that you've been using, just to ensure that you use all of the numbers once, or that you don't skip anything. Okay. 326,040 has been used. Now I am going to deduct my sales returns and allowances. So this is what we are anticipating in having in returns or allowances. Okay, so this number impacts us because, let me see, what's the number? 5360. Because we are expecting this merchandise to be returned to us. So in reality, we need to adjust our sales by our sales returns and allowance figure to be able to calculate our net sales. Okay, so I've got my sales less my sales returns and allowances. I can now calculate my net sales. And your net sales is going to be your sales minus your sales returns and allowances. and that gives you 320,680. Okay, so the first component, which is calculating sales, has been done. It's your sales less your sales returns and allowances. The next thing we have to figure out is the cost of goods sold. Okay, cost of goods sold. Okay, to calculate our cost of goods sold, and let me see, did I mark? No, I did not. Let me mark that off. That way I make sure that I am marking them off as I use them. That one right there. Okay. The next thing we have is our cost of goods sold. Okay. Now for this, it becomes a little bit tricky. They don't give you your cost of goods sold figure. You have to gather the information from the information presented in your trial balance. Now, this would represent your beginning merchandise inventory. Okay. This is merchandise inventory as of January the 1st. Okay. Now that number is not provided. I put 12 instead of 1. Okay, here we go. That number is not provided. What we have here is our ending merchandise inventory. As of December 31st, we had 64,800. Now, whenever we record our updated merchandise inventory, we do make an adjustment to our income summary. So that means that we had to reverse out our initial merchandise inventory. So we can get our beginning merchandise inventory from our income summary account, and that represents my 59,200. Okay? So that would be your 59,200, and that you would get it from your income summary. Okay, so what happened here? I reversed my beginning inventory of 59,200, and then I posted my updated merchandise inventory of 64,800 here. So that's what's going on in this entry. I reversed my original entry, and then I updated with the correct figure. Okay, so we have that, and then we also have our estimated returns inventory. Now that figure is going to be obtained from your income summary as well. If you notice up here, we've got merchandise inventory 64,800. Estimated returns inventory 1,200. Now these two numbers are on this side of the adjusted trial balance, which means that these were my original amounts. So my 59,200 was my original beginning merchandise inventory. My 800 was my original return inventory, or estimated return inventory. Okay, so I'm going to get those $800. Let me mark that off. Okay, and now let me calculate here, and let's see what we get. I'm going to get my beginning, my merchandise inventory plus my estimated returns. That means we're going to get those back. That gives me $60,000. Okay. And then I'm going to go ahead and I'm going to add my purchases. Did I have any purchases during the period? Well, according to this, we had purchases of, let me see, where are my purchases? Down here, of 162,640. 162,640. Okay, so we have purchases of 162,640. Okay, now look at what we have below our purchases. We have purchases, returns and allowances, and purchases, discounts. So those need to be adjusted for so we can get our net purchases. So we're going to go ahead and have our less purchase, returns and allowances, and then less our purchase discounts. Okay, so we have two items, and my purchase, returns and allowance is 4080, and my purchase discounts is 3200. Okay, so I'm going to mark these two off. Okay, and now I can tally these two together, and then that's gonna give me Let me see what's going to give me. We're going to add those two numbers together. And that gives me 7,280. Okay. So now I can calculate my net purchases. Okay. So your net purchases is going to be your purchases minus your total purchase returns and allowances and purchase discounts, which was your 7280. That gives you 155,360. Okay. Now there's another component right below it. We had to pay some freight. Okay, that freight is part of our cost. Okay, so we have a freight of $1,600. Okay, so I'm going to go ahead and I'm going to add my freight in. So I'm going to add my freight in of $1,600. Okay. And then I'm going to go ahead and I'm going to tally that up. And then that's going to give me my cost of goods purchased. So we're going to tally those two up. And we're going to add our 155,360, which is our net purchases, plus our freight in. That's going to give me 156,960. Okay. Now I can calculate my goods available for sale. Okay. And your goods available for sale is going to be whatever we calculated up here, which was our cost of goods sold. Okay. We calculated our beginning merchandise inventory and our estimated returns of 60,000 plus our cost of goods purchased of 156,960. And let's see what that gives us. That plus that will give me 216,960. So that is the goods available for sale right now. Okay. Now that I've got this figured out, I can go ahead and I'm going to deduct my merchandise inventory because that I still have it available. I have not sold it yet. So I'm going to deduct merchandise inventory December the 31st. Okay. And the merchandise inventory that we had as of December the 31st was 64,800. Okay. Okay, 64,800. Now we also had estimated returns of $1,200. Of $1,200. Okay. So we're going to add those together. And that's going to give us our cost of goods sold. Okay, now we can calculate our cost of goods sold. Okay, so these two numbers together will give me, let's see, that will give me $66,000. And now I can calculate my cost of goods sold. And we get our cost of goods sold by getting our 216,960, which is our goods available for sale, minus our total merchandise that we have available right now for sale. We have not sold. That gives me 150,960. So we had available for sale 260,960. From that we deduct what we still have sitting in our warehouse, our merchandise inventories at the end of the year, and that will give us our cost of goods sold of 150,960. Okay. Now we can calculate our gross profit. And our gross profit is going to be our net sales. Our net sales minus our cost of goods sold of 159.60. We're going to get a gross profit of 169.720. Okay. So let me pause here so you can take a look at everything that we've done. First, we calculate our net revenues, our net sales. Okay. Then we calculate our cost of goods sold. Okay. We incorporate our cost of goods purchased. We deduct our goods available for sale to be able to get our cost of goods sold. And then we can calculate our gross profit. Okay. Now from our gross profit, we need to deduct our operating expenses. Okay. Operating expenses. So for that, we're going to look over at our, let me see. Let me just adjust these. I hate it when they move. I just wish I could like highlight, but because it is in Excel, I can't really do that. Okay, here we go. So we're going to go ahead and we're going to deduct our operating expenses. Okay, and I think I need to add a couple more cells because we've got quite a bit of expenses. Okay. Okay, here we go. Okay, and all of our operating expenses are found at the bottom. Okay, so we're gonna go ahead. Anything that has the word expense. Okay, most of the parts that have the word expense are operating expenses. These have to do with the operation of the business. These expenses have to do with the operation of the business. So let's start off with wages expense. Okay. So we are going to start incorporating. The first one we have is wages expense. Okay. And we have wages expense of 69,400. And that's an operating expense because we need to pay our employees to be able to operate our business. Okay. So let's mark that off, 69,400. Okay. Next we have advertising expense. My advertising expense is $1,200. Okay. So we're going to list all of our expenses down here. Okay. Then we have supplies expense. My supplies expense is $800. Okay. Then we have phone expense. So this is just listing all of your operating expenses. Phone expense is $27.36. This is phone expense. Okay. Next we have utilities expense. My utilities expense is $28.64. Okay. Utilities expense. Next we have insurance expense. My insurance expense is $1,600. Okay. Then we have depreciation expense for the building. Depreciation expense, and then this is for the building. My depreciation expense for the building is $10,000. So remember, we're just picking up all of our expenses. Then we have depreciation expense. And this is for the equipment. And that is $1,800. Okay. Then we have miscellaneous expense. Usually your operating expenses will end in miscellaneous expense. Okay. Miscellaneous expense is usually the last account dealing with operating expenses. Okay. Now, if we notice here, we have one more account. That's interest expense. But interest expense is not part of the operating expenses of the business. Okay. That is under other expenses, okay? So we're going to stop there for operating expenses, and we're going to tally that up, and we're going to get our total operating expenses, okay? So we're going to add them all together. And let's see, total of my expenses is $91,000. Now I can calculate my income from operations. This is how much I have left over based on the operations, the revenues, and the expenses undertaken by the business. So I'm going to get my gross profit minus my total operating expenses, and that's going to give me income from operations of $78,720. Okay. Now after that, we have other expenses. These are other expenses not associated with my operations. And for that, we have one item, which is my interest expense that is not tied to the operation of the business. My interest expense is $640. Okay. $640. Interest expense, $640. Okay. I'm going to put that over here. And now we can finally get our net income. So my net income is going to be my income from operations minus my interest expense. That's going to give me net income of $78,080. Okay. Let me highlight this. Here we go. Okay. So if you notice, this multiple step income statement is long. There's a lot of things that we have to incorporate. We have to incorporate, first of all, of course, our revenues, which is where we generated our sales. And then we have to figure out our cost of goods sold section to be able to calculate our gross profit. We deduct all of our operating expenses. And then after that, we deduct our other expenses to be able to generate our net income figure. Okay? So we've marked up everything that we've used. We've used up all of the expenses. We've used up our purchases, discounts, our sales returns. Everything that has been marked has been used up. Okay. Now, this is our income statement. Now we can proceed to our statement of owner's equity. Okay. So let's look at our statement of owner's equity. Now, our statement of owner's equity is usually very short. First, we're going to start off with P. Paulson Capital, January the 1st. Okay. So, according to the problem, our beginning capital, it says here owner's capital as of January the 1st was $504,320. Okay. That number is given to us. So, let me mark that off. $504,320. Okay. So that's going to be my beginning capital balance. Okay. Next, we're going to add any additional investments we had. Now, the problem doesn't tell us if we had any additional investments. All I know is that I started off with capital of $504,320, and I ended up with capital of $534,320. So there must have been an investment of $30,000. Okay, so you get your difference between your beginning owner's equity or your capital balance less your capital account balance on your trial balance, so we can figure out our additional investment. And we figure we had an investment of $30,000. Okay. Now I can get my total investment. I'm going to go ahead and I'm going to add these two together. That gives me $534,320, which is what we have right here. Okay, which is what we have on our trial balance, $534,320. Okay. Now we can bring in our net income for the year. And where am I going to get that number? we're going to get that number from our income statement. Okay. Okay, so we're going to get that number and we're going to plug it in over here. Okay. In net income for the year, we had 78,080. Okay. We're also going to deduct our withdrawals. We had withdrawals of $4,800. Okay, so we had withdrawals of $4,800. Now I can calculate my increase in capital. Okay, how much did my capital increase by? Well, I had income for the year of $78,080, and then I withdrew $4,800 for personal use. That leaves me with an increase in capital of $73,280. Okay. Now I can calculate my ending capital balance. Okay. And my ending capital is going to be my total investment amount of $534,320 plus my increase in capital of $73,280. That's going to give me my ending capital of $607,600. Okay. So this is my owner's equity. You start off with your beginning capital. Make sure that you compare your beginning with your ending, subtract to get your additional investments for the period. Then you have your total investment. That $534,320 should give you the same amount that you have on your capital account. Okay. And then you bring in your net income from your income statement. You deduct any withdrawals for the period. That will give you your increase in capital, increase or decrease depending on the situation. Once you have that figured out, you can just calculate or add your total investment plus your increase in capital to get your ending capital balance. Okay. So that is your statement of owner's equity. Now we have our balance sheet. Okay, they're asking us to prepare a balance sheet. In our balance sheet, we have our assets, liabilities, and owner's equity, and the whole point is to balance. The accounting equation must balance. Okay, so we're always going to begin on the balance sheet with our assets. Okay, we have two different types of assets. We have our current assets. These are any assets that you can convert to cash in less than a year. Okay. And we're going to look at our assets section. Our assets are in the very top. We've got cash of $23,440. Okay. Let me just format these real quick. That way they have comma. Okay. So we've got cash of $23,440. We also have accounts receivable of $93.60. Remember, your accounts receivable should be collected within 90 days. Okay, the faster you collect it, the more likely is it that you're going to collect. So it's very important that we collect any receivables promptly. Okay, we've got accounts receivable of $93.60. Okay, we also have supplies of $2,400. Okay, another thing that we have to incorporate, I know we incorporated our merchandise inventory into our income statement, but what we did here is we incorporated it to be able to calculate our cost of goods sold. Now, our merchandise inventory, that is something that we own. It's something that belongs to us. It's something that's sitting in our warehouse. So it is an asset. So your merchandise inventory also needs to be included into your balance sheet. So we're going to add merchandise inventory. And my merchandise inventory is 64,800. There we go. Okay. We also have estimated returns inventory of 1,200. Okay. We have supplies of 2,400. Okay. We've got prepaid insurance of 1,800. Remember, these are assets that are going to be either collected for or used up within a year. Prepaid insurance, 1,800. Okay. Let's see, what else do we have? Okay, the next item we have is land and then building. Now these go in a separate category. The first category that we're working on are current assets. These are any assets that are going to be converted to cash or used up within a year. Okay, so land and building are going to last us longer than a year. So those do not go under current assets. So these are all of my current assets. Now I can calculate my total current assets. We're going to add all of those assets up and we're going to tally it and get a total. So my total current assets are $103,000. Now I have another category called property, plant, and equipment. Okay. Property, plant, and equipment. Okay. In here, I've got my land. How much did I have in land? I had 90,000 in land. Okay, 90,000 in land. So I'm going to bring in my land figure. Okay. The next thing we had was the building. Okay. Okay, the building is $350,000. Okay, building 350. Okay. Now I'm also going to deduct the accumulated depreciation on that building. Okay, $20,000. Okay, and my accumulated depreciation was 20,000. So that means that my book value for my building is going to be the 350 minus the 20. That gives me $330,000. Okay. What else do we have that's going to last us, that's going to last us longer than a year? Let me mark this off. We also have store equipment of $120,000. Okay, store equipment. 120. Okay. And I am going to deduct the accumulated depreciation for the store equipment of $3,600. You always have to adjust whenever you have an asset and it has depreciation, you have to adjust that asset for that depreciation. So I've got accumulated depreciation for the equipment of $3,600. Okay. And that was how much was my depreciation for the equipment? That was $3,600. $3,600 right here. Okay, $3,600 adjustment right there. So then my book value for the equipment is going to be $116,400. Okay. Now I can tally these three numbers up, which is my land, my building, and my store equipment. And then that's going to give me $536,400. Okay. Now I can calculate my total assets. Okay. To get your total assets, you're going to get your total current assets plus your total property, plant, and equipment down here of $536,400. And then that's going to give us $639,400. Okay. $639,400. So I'm going to highlight this number because we need to tie back to that number. Okay. Now we're going to move on to the liability section. Okay, for my liabilities, we have two types of liabilities. We have current liabilities, and then we have long-term liabilities. Okay. So current liabilities are anything that are due within a year. Long-term liabilities is anything that's long-term, that's longer than a year. Okay. Now we go back to the problem. It says that the owner's equity was $504,320 and that the current portion of the note payable is $2,000. The current portion of the note payable is $2,000. Okay, so that is telling me that that is a current liability. That's a current portion, $2,000. Okay, so let me mark that off. $2,000. Okay. So we have a note payable of $2,000. Okay. Now let's go back to our liability section. Okay, we have accounts payable of $95.60. Usually our accounts payable needs to be paid within a year. So we've got accounts payable of $95.60. That's a liability. Okay. Let me mark that off. Accounts payable. Then we have customer refunds payable, $1,600. That's also a current liability. That is $1,600. Okay. We have wages payable of $1,200. Okay, so my wages payable is $1,200. Okay, what else do we have? Wages payable, $1,200. Let me mark that off. And then we have sales tax payable of $34.40. Okay, let me mark that off. And last but not least, we've got a note payable of $16,000. Now, a note payable is usually longer term. It's not a short-term liability. So we're going to skip that and we're going to wait to put it into another category. So those are all of my current liabilities. We're going to go ahead and we're going to add them together to get our total current liabilities. That gives me 17,800. Okay? Now we have another section called long-term liabilities. These are anything that you owe past a year. If it's going to take you longer to pay than a year, you're going to have long-term liabilities. Liabilities. I can't spell correct. Okay. Okay. Now we only have one long-term liability, which is that note. Okay. We have a note payable of $16,000. Okay. $16,000 right there. Now, note payable $16,000. Okay. But remember, out of those $16,000, I'm going to deduct the current portion. Remember, $2,000 of it was due this year. So I'm going to deduct $2,000. Okay. That is going to give me a long-term liability of 16,000 minus 2,000. That means I owe 14,000 in my long-term liabilities. Okay. And now I can calculate my total liabilities. Okay. So your total liabilities, we've got your total current liabilities of 17,800 plus our current our total long-term liabilities, which is 14,000. That gives me total liabilities of 31,800. Okay. Now, last but not least, we've got our owner's equity section. Okay. So for my owner's equity section, I'm going to bring in my capital balance. We're almost done, class. It's just long and tedious work, but it's just transferring information from your trial balance over to your respective income statements. Now, where am I going to get my capital balance from? You're going to get your capital balance from your statement of owner's equity. Okay? So that number, that 607,600, is going to go all the way down here. Okay, we're going to transfer the amount from your statement of owner's equity to your balance sheet, and that's going to give me 607,600. All I did, 607,600. All I did was transfer my balance from my statement of owner's equity, 607,600, over to my balance sheet. Now I can calculate my total liabilities and owner's equity. Okay, so I'm going to add my total liabilities of 31,800 plus my equity of 607,600. That gives me 639,400, which is the same thing as my total assets. Okay, if your total assets do not equal your total liabilities and owner's equity, then you made a mistake somewhere. Okay, it's important that you go back and locate it. Your balance sheet needs to balance. That is the whole point. Okay, the areas where I see students get confused is the breakout of the notes payable, the current and the long-term portion. Remember, we have 2,000 that is current. That means 14,000 is long-term. Very important that you transfer the numbers correctly, because a lot of the times it's just a simple typo that's causing you to be out of balance. Review the information carefully. As you're transferring the information, be very careful what you're transferring. Okay, now this is your balance sheet. Your total assets must equal your total liabilities and owner's equity. That is a rule. Okay, so these are your three financial statements that you have to prepare. Like I stated earlier, you are going to see something like this on your upcoming test. So it is super important that you practice. Remember, you do have 2 tries on your homework. If you don't perform very well or you need extra practice, please utilize the second attempt provided. Remember, I always keep the highest grade earned. So if you do worse on your second try, I'll always keep that better grade. Okay? So these are your three financial statements for a merchandising business. I hope this lecture helps you a little bit. Look at the different information that goes and how it flows into your different financial statements. And I want to wish you all a wonderful rest of your week. Have a great day. Thank you.